To the LinkedIn, YouTube, and Twitter universe, welcome to this very timely and important discussion. My name is Michael Wardy. I'm a certified financial planner and regional director at Source Advisors. With the recent passing of the COVID relief bill and earlier this year with passing of the CARES Act, there's been a lot of questions throughout the year. And I'm fortunate to have access to two very technical gurus. I hope you guys don't mind me saying that, who have done a lot of research and analysis throughout the year and are joining me today to go over all this year's changes that have taken place and what we believe are important information and topics and pieces for businesses for what's a little bit left of this year, as well as 2021 and going forward. Gentlemen, welcome.
Thank you, Michael.
Brian.
Michael.
Thank you. Let me introduce you guys so that everybody out there knows exactly who you guys are to a certain level. First, I'd like to introduce Charles Duncan, who is our senior technical director and actually started Source Advisors cost segregation practice back in 2003 with more than 20 years of cost segregation experience and having managed literally thousands of studies. I can tell you that he and his team have performed studies on every type of building. So thank you again, Charles, for joining. Next, I'd like to introduce Brian Coddington, who provides compliance, consultation, and audit representation services for clients in the areas of tax accounting methods. Brian's represented taxpayers before the IRS in matters involving UNICAP costing methods under Internal Revenue Code Section 263A and, of course, cost segregation. So, gentlemen, we have a lot to go through.
It's been a heck of a year.
So let's just get started. I have some questions that I had sent out, requests for questions from some of the potential audience members. And as we go through this, there's going to be more questions out there in LinkedIn, in YouTube, and Twitter. If you have questions, type in your questions, send them in. We will try and get to those. But just to get started, let's go back to April and the beginning of the year with the CARES Act. And really, I've been hearing from the CARES Act that they fixed the retail glitch. What does that mean?
Absolutely. When we began 2020, before we knew what COVID was going to do to us, we started the year with a large number of open questions that had stemmed from the Tax Cut and Jobs Act, which was passed in December of 2017, as well as a number of other topics that had just been open-ended for a long time. There really had been gridlock in Congress about addressing some of these questions. The retail glitch is a prime example of that. Thanks to COVID, maybe this is the only thing to be thankful of COVID for, Congress actually decided to cooperate and signed into the law the CARES Act, which amongst other things addressed the retail glitch. The retail glitch was a drafting error in the Tax Cut and Jobs Act. The intent there was an intent within the Tax Cut and Jobs Act to embellish an existing type of property for depreciation purposes called QIP, Qualified Improvement Property. Prior to the TCJA, we had other types of Q property, qualified leasehold, retail, restaurant. And then we had this QIP category, and it would get very confusing. So the TCJA was trying to simplify things, create one type of Q property that would have a 15-year depreciable life, would receive bonus depreciation, and would qualify for Section 179 expensing. Unfortunately, due to a drafting error, we spent more than 2 years with that not occurring. And it's called the retail glitch because this error affected retailers more than most businesses. Really affected anyone who was building out new interior improvements of existing buildings, where the intent had been for them to have this 15-year life and to qualify for bonus depreciation. Instead, those improvements were not receiving bonus depreciation and were depreciating over a 39-year period. It was an accident. And the retail glitch, that's what, in common parlance, that's what it started to be called, because the retailers felt the pain more than most. And the CARES Act addressed that.
Good. Well, thank you. Thank
Sure.
you. Brian, did you want to add?
I was going to see if Brian wanted to add anything there.
Yeah, I was just going to ask.
Yeah, retail glitch was, well, first, it started out as a drafting error. And you look at the conference reports from the TCJA, and you clearly see Congress saying, okay, we wanted this to be 15-year property eligible for bonus depreciation. And what can we do? Rolls around to Treasury and the IRS, and they say, well, yeah, but even though it's clear that you made a mistake in drafting the statutory language, we have to follow the statute. So we're actually going to say no. And this puts a lot of taxpayers in a tough position. They could follow Treasury and the IRS. They could follow the statute as written and not take bonus depreciation, not use the 15-year recovery period, and wait for a fix, or they could just go ahead, take it, and let the chips fall where they may. And a lot of taxpayers did take that approach. I'd say the vast majority complied with the actual statute, but a substantial minority, did take the more aggressive approach of just going with congressional intent. And that's why I think we see, especially with a lot of reports about, well, the CARES Act fixed the retail glitch, but we're not seeing a huge change. We're not seeing all these NOLs like we expect. We hear that from, government reports. Well, I think the answer is very simple, is that, look, a lot of people were more aggressive and took bonus depreciation anyway. And so we're going to have to look at the smaller taxpayers, the ones more concerned about audits, the ones more concerned about compliance risks, and they're the ones who, especially with the pass-through entities, who we're going to actually be making the changes, not necessarily large taxpayers with C corporations. At least that's what I've been seeing in practice. Is a lot of the largest taxpayers just went ahead and went with congressional intent instead of waiting for a fix. And gotta say, the fix, it did more than just clarify what we're doing with the 15-year. A lot of people had started to say, well, this is improvement. So if we have anything called, improvements on the books, we can treat it as QIP, and it's 15-year, no matter who made that. And if you look at the CARES Act, you'll see that they added a line, improvements made by the taxpayer. They added made by the taxpayer. And that's really cut down on the eligibility of people for QIP. The intent was apparently that you're going to start out with QIP that is, someone makes 10 improvements, someone does a leasehold improvement project, they have a build out for a specific tenant, for a specific building, and that's going to be QIP. But if you're, once you add in, before they added in that made by the taxpayer language, QIP, a lot of people interpreted that as something much broader, where if you had any sort of leasehold improvements on your depreciation schedule, it would qualify as QIP as long as it was made after the building was placed in service.
But I think that's a minority position. I certainly wasn't running into it very often.
I didn't see it very often, but it did happen.
It did happen.
There
were certainly taxpayers who would view tenant improvements that were acquired through purchase as being QIP. Those tenant improvements were put in place after the original building was. So there's been at least three owners. Whoever, or not necessarily three owners, but there's been three incidents: the original construction, tenant improvements being placed in service at a later point in time, and then a purchase by the current taxpayer. And it's at that point where some people chose to interpret it aggressively and applied QIP, even though they were not the ones responsible for those tenant improvements placed in service after the original building. But I think it was pretty clear from the language at the Path Act, if you want to go all the way back to 2016, that when QIP was originally written, that the intent was certainly for it to be new interior improvements by the current taxpayer, even though it didn't perhaps say that exactly the way the new language does in the CARES Act.
Oh, definitely. I think the language, I mean, I think you and I both always interpreted it as the improvement has to be an improvement in the hands of the current taxpayer.
Right.
And if you look at the language in the regulations that deal with improvements, if you look at how improvements are traditionally treated in the code, then you aren't buying improvements necessarily separate from, you're just buying a single asset typically that can be cost segregated, of course, when you buy a building. But you aren't buying, you're buying an asset. You're not buying an asset and then having improvements made on it instantaneously, I guess you'd say.
Yeah.
But yeah, the CARES Act was a great opportunity, and it remains a great opportunity. But I think we should, turn back a little to the CARES Act. That part of it is a fix for the retail glitch,
Right.
part of the TCJA. And when we first started this year, we were still in waiting mode for tons of regulations for the TCJA. Even though it had been a couple years since the law came out, there were so many changes that we're waiting for final and proposed regs on many different subjects.
Sure. Yeah. How do you interpret the bonus depreciation under the TCJA and the binding contract rules? How do we address the change in the rules for 1031 like-kind exchanges? The 163J, and its effect on bonus depreciation, and specifically in regards to auto dealers. And these were all open topics when we walked into 2020. Little did we know how interesting 2020 was going to end up being. And then I think it's actually it's worth mentioning, or even congratulating the IRS on the sheer volume of work that they accomplished this year and getting all these regs out. That we haven't really gone down that road talking about the regs yet, but they turned out a large volume of regs.
Yeah, I like to compare it to, I mean, some people said that the TCJA was a once-in-the-generation event similar to the Tax Reform Act of 1986. And I wasn't around for TRA 86. I mean, I was alive, but I definitely wasn't practicing. But looking back, you can see, 86 rolled down, and a lot of those final regs for TRA 86 came out in 93, 94. You had 7-8 years separation. In fact, some of the regs that we see for TRA 86 are still in temp reg form decades later. But with the Tax Cuts and Jobs Act, I believe everything at this point dealing with depreciation, except some very small issues, has been addressed, and usually in final reg form. Less than, we're at 3 years now, and they've churned out reg project after reg project, been very responsive to taxpayer and practitioner comments, and we are in much better shape, I'd say, with these regs than the ones that took 7 or 8 years to formulate back in the 1980s and 90s.
That's encouraging.
It's been pretty impressive. And if you've been following the development of the regs since the end of 17, you'll know it hasn't been a straight line. I mean, the regs, the temporary and proposed regs, for instance, for bonus depreciation, there's a pendulum that was swinging in terms of how things are being interpreted before we got to the final reg form. So much of what we ended up with were not foregone conclusions at all. You see this with 1031 as well.
Yeah, that's actually a great point. I know you and I have been giving a lot of presentations lately on the Section 1031 proposed and now final regs. It took them a little while to get around to that. The TCJA restricted the definition of the property that can get a like-kind exchange, and there are probably people out there in the viewing audience that don't really know what a like-kind exchange is.
Mhm.
And so I'd like to go back to, the basic idea was it was 1920 something. And the US had a very agrarian economy. And that means we had lots of farms, lots of ranches. And something that would very frequently come up in practice back then, based on what read about in the history books, is that you'd have two adjacent farms, let's say. And you'd have one farmer that had, say, 10 acres that were unused at this point, and they really didn't, have any need for them. And you'd have another farmer who had 8 acres that they weren't really using or needed, but the first farmer wanted those. And so they'd just swap them. And the problem is that that's a realization event. And at the time, it was a recognition event too. They bartered it. So even though no cash had changed hands, they'd have to include in income, recognize gain or loss on what's potentially relatively low basis assets. And they wouldn't even have the cash to pay for it. So Congress, of course, stepped in to help our farmers and said, well, you can defer that gain on the swap. We'll call it a like-kind exchange. And we've had a lot of developments over the century that we've had that. But generally, through all those years, there's a basic idea. You could exchange real property, like farmland, for other real property, like a building. You could exchange personal property, like a car used in a trade or business, for, say, a work truck used in a trade or business. Personal property for personal property. Now, we're not going to drill into all those niceties about, well, what was personal property, but because that doesn't really matter anymore, because the TCJA came in and restricted like-kind exchanges to real property only. So we needed to know what was real property. And there were a lot of answers. There were answers about, traditionally we look to state law, and it gives us one answer. Other people would say, oh, we'll just do what we do for depreciation. And once you've cost segregated property, there's some things that get a shorter life, like QIP or land improvements, are going to remain real property. Other things are going to be called tangible personal property, even though they're a fairly permanent part of a building, such as electrical or plumbing that supports a particular machine. And so when we got around to trying to match that up with like-kind exchanges, if you had to classify everything in a building that's personal property for depreciation purposes as personal property for like-kind exchange purposes, well, one, the big problem is that even an exchange anymore, because you're selling real property and you're getting real and personal property back. So you at least have to recognize some gain on the exchange, or is an exchange at all? And so when we're looking at those, that was a hugely problematic approach.
Well, I think, and I'm sorry to interrupt, but a big part of the issue here is the loaded language. That the same terminology is being used for as many as 3 different purposes. Property tax uses the same language that federal depreciation law uses, which is very similar to the language that's being used for 1031s. But there's different meanings behind them, and that's where it gets confusing. And this is something where it used to really be swept under the carpet for the most part under the old understanding of 1031 exchanges. But when you get this change under the TCJA that's specifically precluding us from including the personal property, now these terms, the specific definitions of these terms are important, but good luck finding some place that lays out which definition goes with which term in which situation. Hence the need for the regs.
Exactly. And even though it took 2.5 years, the Treasury did come out with regs finally in in June of this year, and they were good. They proposed a lot of inherent permanency tests, a lot of facts and circumstances, multi-factor tests that would determine whether something's real or personal property for 1031 purposes. And then a lot of people didn't like them because you'd still get answers where some of the stuff that's cost segregated out of a building would remain personal property. And so the government was very nice to us. They said, okay, you can take an either or approach. If it's real property under state law, it's real property for 1031 purposes. If it's real property under these regs using the inherent permanence tests, it's real property for 1031 purposes. And as long as you hit one of those, it's generally going to be real property. So most cost seg assets are now going to be real property, which is great news for the industry.
Okay, and let me try to describe why this is, more specifically why this is an issue. If we're looking at a piece of machinery and equipment for a manufacturing process, generally everyone agrees that that's personal property. For federal depreciation purposes, which is why you're performing a cost segregation study, we're able to also reclassify any conduit, wire, switches, junction boxes, circuit breakers, anything that's necessary for the function of that machinery and equipment is characterized as personal property for federal depreciation purposes. If it wasn't for that piece of machinery and equipment, this item of this electrical conduit and wire would, be no different than any other electrical conduit and wire. It is inherently permanent; it's baked into the walls of the building when it's under construction, and so under state law that would typically be real property. It's indistinguishable from the rest of the building. But for federal purposes, we're able to dig into the walls and identify this stuff. And we have a lot of case law that allows us to go in that direction that we've been relying on for many decades. And so this is one of the big areas where you see a divergence from property tax, state law versus federal depreciation. And it's why this is why it's important to distinguish between the two with the 1031s.
Exactly. And, speaking of regs, we did see other reg projects come down, and some of them have been really important. We saw final bonus depreciation regs.
Mm-hmm.
We saw final regs for Code Section 163J related to the interest deductions. And we also saw final regs for small taxpayers. It came out, they still haven't been officially published yet, as far as I know, but they came out quite recently. And we've also seen final regs for these 1031 exchanges, which we've already handled. So, there's a lot of stuff. The final bonus regs are really interesting in that they, for most taxpayers, they didn't actually do a whole lot compared to the previous iteration of final bonus regs from 2019 or proposed bonus regs from 2018. You can see a lot of iterations of stuff have come out over the years. But one thing that they did do is they provided us with a component election for buildings that were under construction when TCJ was effective for bonus depreciation, or 9/28/17, whichever you want to call it. And this component election, in a lot of ways, it provides a simple test, and that is, if you have more than 10% of the actual physical construction work paid or accrued as of 9/28/17, then you can apply the component election. And basically at that point, anything before 9/28 gets Path Act, anything after that gets the TCJA's full 100% bonus. And if that test doesn't apply, if you're under 10%, well, everything gets TCJ 100% bonus, which is a great result. Kind of pushes us back to where we were in 2011 or so when we last had a change from 50 to 100% bonus.
Well, what I think is interesting at the bonus depreciation is for you and I, this final reg was meaningful. We've we've been getting hung up on how the interpretation of bonus depreciation has swung. That pendulum has swung back and forth over the last 3 years basically. And in our practice, we were getting hung up on that. In many ways, it's addressing a problem that most people were ignorant of existing. That many taxpayers were handling the bonus depreciation incorrectly until almost 3 years later, when the final reg comes out and retroactively allowed them to be correct, even though they didn't know why they were correct, but now they are. For your regular taxpayer, I think that the CARES Act was more impactful bonus depreciation wise, even though it wasn't strictly speaking creating regulations for bonus depreciation or changing the bonus depreciation rules. By fixing the retail glitch, addressing QIP property, that had a greater impact on how people were using bonus depreciation than the actual bonus depreciation regs, which made those of us who are nerds, made us kind of, we were excited to see that fixed, finally.
Exactly. And honestly, the component election is something, if you're a taxpayer in certain industries where you tend to make giant machines, say a utility, heavy manufacturing, then you would be familiar with the component election and what preceded it. But the component election, honestly, it gets at one point what to do with cost segregated buildings. If you're just buying assets, making normal improvements, you typically don't care about this election. You buy an asset, you acquire it, or self-construct it, you look at the rules, and you look at the place in service state, and you get an answer. It's pretty simple. And where the component election comes in is where you have a large self-constructed asset, and it has components that some of which may qualify for bonus depreciation. And so it's really aimed primarily at cost segregation. And that's why it doesn't actually come up for most taxpayers, is that if it's a project that's not going to be cost segregated, such as a lot of taxpayers out there, they have tenant improvements. They lease a space, they put in their tenant improvements, and it's either going to be all QIP or a mix of QIP and 1245 assets, gets 100% bonus depreciation anyway. No one cares. It's only when you start putting in a larger construction project, such as an entire building that's cost segregated, that anyone cares. So for most people, yeah.
And it's only this change in the regulation that we got so excited about. It's really only impactful for taxpayers who had a building under construction prior to 9/28 of 2017, and it was completed after 9/27/2017. It's those long construction projects that are bridging that transition period from the Path Act to the TCJA where this is impactful. Most taxpayers at this point have kind of moved on from that. What's being placed in service today, was begun now after 9/27, generally of 17. But in our world, where we perform lots of cost segregation studies and we're able to go backwards in time and look at buildings that were constructed previously, that this does have an impact on what we do on a day-to-day basis.
Exactly. And speaking of this issue, it's really about when a building begins construction. And that's an important point because we have another provision in this new omnibus spending bill, which, this omnibus spending bill, I believe it's called something like the Consolidated Appropriations Act, but each actual section of it has different names. Like there's one part called the Taxpayer Certainty and Disaster Tax Relief Act of 2020, which
What's the acronym for that?
Yeah, exactly.
I honestly don't know. I had to switch browser windows briefly because I don't have that memorized yet because it just came out.
Doesn't roll off the tongue, does it?
No, not exactly. And it's when we look at it, this is the extenders. And I know there are probably some people out there who are hoping we get to talking about the PPP loans and round 2 for that, and the the employment credit that's related to the CARES Act and to this new omnibus spending bill. Unfortunately, we're not really going to cover that. We're going to cover things that are primarily related to depreciation.
Yeah, and I do want to point out that there's I'm working on having a follow-up presentation, LinkedIn Live, YouTube, and Twitter with a group that specializes specifically in that area. I'm bringing them on
Good.
and walking.
Awesome.
Yeah, so that'll be a separate one. Watch out for that.
Well, good for me to tee that up for you. Great. That was totally unintentional, but all right. So extenders. Everyone at this point has probably heard of extenders. And tax extenders are the result of Congress putting in temporary incentives. And these temporary incentives, the cynic will say that they're there so people can lobby every year or 2 or 5, as the case may be, to get them extended. But honestly, most of them they're trying to get economic growth or some other activity happening along certain lines, and they are expensive. They count as an expenditure, so Congress is, of course, trying to avoid making tax expenditures. That's why they're temporary, and it's really expensive to make them permanent. And the reason I mentioned the beginning of construction being important is this latest extender round made the Code Section 179 Cap D, that's capital D, energy commercially, it's commercial energy efficient deduction. They made that permanent.
Mm-hmm.
And
how long has it been around? We've had it. This is something that has expired and been retroactively brought back multiple times.
Oh, it's been around.
It started in 06.
06.
Yeah, 14 years or so.
Yeah.
14 years of being in a temporary status, dependent upon each extender's bill to bring it back.
Yeah.
Which isn't the worst. I mean, we can look at some provisions that have been around
R&D
temporarily.
Yeah, R&D.
80s.
R&D is permanent now, and it was around as an extender for 30, 35 years.
Up until
the energy credit.
Yeah.
The energy credit, some of its provisions have been extended, for similarly at this point for around 35 years.
Mm-hmm.
So there are a lot of, or actually 40 years maybe, some of them, but there are just a lot of provisions that keep getting extended. 179D, the basic idea is you have certain energy standards. And if your building exceeds these energy standards, you get a deduction. It allows immediate expensing of certain costs for the building related to what's usually a 39-year recovery period gets immediately expensed, which is a great deal. And if you qualify for the full benefit, you get capped at $1.80 per square foot. So you can't say, if you have an energy efficient lighting system and roof and everything else, you can't just deduct all of those immediately anyway. But you can, get this capped $1.80 or in some cases partial 60-cent deduction. But the cool part about the new extenders is not only is this permanent, but those amounts are indexed for inflation. but they come at a cost. And that cost is Congress no longer has to update the energy standards in the statutory language. Instead, they automatically, well, sort of automatically update. The Secretaries of Treasury and Energy have to affirm new standards.
Mm-hmm.
And this is about the beginning of construction because, as the statute reads currently, it basically says that the energy standards for a building are going to be no newer than the ones that applied 2 years before the building began construction.
That's how it is now, right?
Yeah, post extenders, yes.
And for a lot of buildings, it takes them a couple of years from the beginning of construction to when they're completed.
Right.
So realistically, in many cases, you're going to be looking back at standards that are at least 4 years old, which is actually good news because you want your new technology to be an improvement over what the standard was however many years ago.
Walk through what, if you guys can remember, and I just don't remember this. What were the standards before this change, in terms of what year were the standards based off of? I thought they were based off of 11 or 7 or something like that.
I thought they were 2007, but I always have to check.
Yeah. But for us, or for anyone who's doing 179D studies, it was fantastic because the old standards have been put in place prior to a lot of the technology that we're currently using, such as the widespread use of LED lighting. And Brian started going down this road talking about the different ways that 179D can qualify, and it's based on the HVAC system, exceeding the standards, the lighting system, or the building envelope. And for many new buildings, if nothing else, the building envelope, the building lighting would qualify pretty easily because all new lighting is a great improvement over the old standard.
It is based on the 2007. Thank you.
Yeah. Awesome. Well, so we don't quite know how long the affirmation process is going to take. It can cause some problems, perhaps, because a building, it does usually take a couple of years to get built, but it often takes 2 to 5 years to plan the building beforehand, to get permits, everything lined up. So it's quite possible that this could have some negative effect, but we really just have to go into wait and see, because we don't know how long the affirmation process is going to take. We don't know what standard is going to be adopted for buildings currently under construction that haven't been placed in service yet, but it will be placed in service in early 2021. So there are a lot of unknowns, and we're going to see a lot of, hopefully some helpful government guidance on this in the next few months. I want to remind people that 179 Cap D, we don't typically get regs in the area. We are working off notices that have been around for many years at this point, so we should expect something to come out in just a normal notice format, hopefully.
Have there been any changes in terms of buildings that qualify? I know before this, for years, we would get clients that would call us and ask us if nonprofit buildings would qualify. Did that get changed at all, or is it still they don't qualify? Do we know?
Well, it depends on what you mean by nonprofit. Of course, if it's a municipal or government entity, the designer could get the actual deduction.
Right.
But if it's a tax-exempt org, no, that hasn't changed.
Okay.
Still limited to just governments or taxpayers' businesses. Yeah.
Application. Okay. Perfect. Okay, so that was the question. Oh, go ahead.
And there's one other provision. Since we're talking about energy efficiency, that was also included in this omnibus spending bill, and that's 45L. And 45L was not made permanent. It is simply extended for 1 year, and 45L is specifically a provision that applies to housing. And it's pretty generous. It's a $2,000 per door credit. So whether someone and then it's the developer who's benefiting from this generally. So whether it's someone who's developing single family homes it's $2 per house credit, should those houses qualify. Or if you're looking at a multi-tenant apartment building or something along those lines, you think about if there's 100 doors, or 100 units, that is, or 500 units at $2,000 per door, the credit that qualifies for the credit, that ends up adding up significantly. So that was extended for 1 year.
And it's a huge credit when you think about it. And you have some of these builders that are building, apartment complexes or communities with row houses. That adds up. That's real money.
It adds up. I live in North Texas, the Dallas-Fort Worth area, and our developments are really big. It's not unusual to have a several hundred unit apartment complex or housing development, which is hundreds of homes. So this is really significant.
Yeah.
Yeah, it is. And there are actually other extenders that are relevant too. The energy credit, a lot of its provisions got a 2-year extension.
Mm-hmm.
There's been an extension for
racetracks,
motorsports complexes, Indian reservation property.
Wait, let's go back to
the racehorse. So which one?
The racetracks. Let's talk about that.
Well, presumably NASCAR has a great lobbying arm.
Okay.
But this has been around for quite a long time, that the motorsports facilities have a 7-year tax life.
Mm.
And they got go ahead.
They got a 5-year extension. Most of these are 1-year extensions for, say, Indian reservations. But there's actually a really neat technical correction buried in this act too. And one of the big things, I mentioned 163J and the interest limitations earlier.
Mm-hmm.
The basic idea is that, our tax system historically has favored debt over equity. And so part of the TCJA was to say, okay, except in certain cases, you're going to have to limit your interest deductions to the sum of your business interest income plus your, at the time, 30% of what we call tax EBITDA, and plus your floor plan financing interest if you're an auto dealership. And putting aside the floor plan financing interest for a moment, the big issue with this was, there was a carve out, and the carve out was for qualifying real property trades or businesses. And these guys, if they made an election, they got to take unlimited interest deductions, which is great for their industry. They tend to be highly leveraged. But unfortunately, one of the costs of that was you had to use the alternative depreciation system for certain types of property. Your QIP, your qualified improvement property, it went from 15-year property to 20-year, post-CARES Act at least, and it no longer qualified for bonus. Your 39-year building had to go to 40-year. And your residential rentals, well, that's where it got tricky. The TCJA changed the alternative recovery period for rentals, residential rentals. It used to be 40 years, just like any other building, and now it is 30 years. Problem, though, the huge problem was that this applied going forward. So all your pre-TCJA residential rentals ended up as 40-year property if you made this election. And what this technical correction does is it makes all of them, if you make this election, the recovery period is going to be 30 years for all of them, which is a huge simplification. And because it's a technical correction, I anticipate that the service will take a two-pronged approach to it when they issue procedural guidance. One, they'll allow taxpayers to file Form 3115 in the current year, get a small negative 41A adjustment perhaps. And secondly, they'll be able to take, probably file an amended return, because I'm sure there are some taxpayers out there somewhere who did not make the election because the math didn't work out at 40 years for their residential rentals, and at 30 years it would. So it's going to be a good deal for them. So they'll probably allow that on amended return or 3115. Don't know yet, but we definitely suspect that we'll have at least a 3115 option, not just amended returns.
Yeah.
And that's because it's a technical correction, and that's following what they did post CARES Act for other technical corrections.
What about, let's switch gears a little bit. And that, just so everyone knows, that was question number 1. Just kidding. That made me laugh, and I was thinking about that in my head. Small taxpayer changes and benefits. What did we see from that?
Oh, wow. So this was part of the TCJA. And the TCJA basically said, if your taxpayer, if your entity, your business is a small taxpayer,
Mm-hmm.
so that was basically, at the time, less than $25 million in average annual gross receipts over the prior 3 years.
Mm-hmm.
The first got pointed out, that's gross receipts, not profit, not gross profit, not bottom line, top line, gross receipts. Second, that it's over the 3 prior years. And it was 25 million in 2018. It's been bumped up to 26 million in 2019 and going forward because it's indexed for inflation.
Mm-hmm.
So you have, if you're smaller than this size, and if you're not a tax shelter, and this is one of the huge issues, is that a lot of companies are tax shelters under this provision, even if they aren't tax shelters in any other way. And that's because it uses the old syndicate rules, which basically comes from the 80s. The idea is if you have limited partners who are getting allocated more than 35% of the losses, you're going to be a tax shelter.
Mm-hmm.
Same logic applies to corporations, except they call them limited entrepreneurs. And so if you have a loss year and you have limited entrepreneurs or partners, and they get allocated more than 35% of it, they're a shelter, which is a horrible, especially post-COVID, a horrible result. The new regs did alleviate that a little by making an election where you could an annual election where you could look at the prior year's position, whether you were in loss or profit. So that's good. But one of the bad things is that you still have this rule. The final regs did not get rid of it. And they say only Congress can fix it. So hopefully Congress takes them up on that and does fix it, because a lot of very small taxpayers, including a lot of real estate partnerships, get tripped up on it. I mean, if you have a 2-person partnership, 50-50, one person put up the money, the other puts up the sweat equity, and they own a rental, and all of a sudden you have to comply with not only basic tax accounting rules, but also 163J with the interest limitation, well, it could be bad. And yes, I know that for rental business, they'd be able to make the election and avoid it. But anyway, so what these small taxpayer rules do is they allow you to use the cash method. They allow you to avoid using UNICAP, which is comprehensive costing rules that came out in '86 that require you to generally capitalize more stuff to inventory or self-constructed assets than you would have pre-'86. And you also have options under the normal inventory rules. In some cases, you can even expense your inventory, but that's only if you can expense it on your books and records. If you have any sort of books and records where you're taking an inventory in general, you won't be able to expense it. And then in other cases, even where you can't expense it, they had a great option. There was a ambiguity in the historical rules for inventory for small taxpayers. And that was, okay, we know you have to include the direct material costs, say for raw materials when you're manufacturing something. Do you have to include the direct labor costs? And so already under the previous proposed regs, you could expense labor and overhead that's indirect. But what about the direct labor? Well, in some cases, you can now expense direct labor as well if you make a certain type of election. Great rule for manufacturers. I believe a lot of manufacturers will take advantage of this, and they should save substantial amounts of money on their inventory, especially if they're able to switch to the cash method. But I do want to point out that this is for small taxpayers. Taxpayers may get aggregated with other entities that they own, whether
Is that based on over 50% ownership, common ownership?
no, I wish it was that simple. There are a lot of rules that apply that attribute ownership across relatives, across entities, and the IRS actually has a super useful FAQ on their website that goes into detail on how to apply these across the many different code sections that use these rules. So if anyone has any questions, that's the place to start.
Okay.
But these are great rules for true small taxpayers. Unfortunately, I have bad news in that for like the cost seg perspective, we don't really have any more news. I mentioned self-constructed assets in UNICAP, and the Treasury basically said, we're punting on this issue because it's outside the scope of the regs, but it's not really because no one knew how to treat self-constructed assets pre-86. Well, I mean, obviously people practicing back then knew how to do it, but even people who have been in practice that long, I think it sums it up best when they say, and one of them in their comment letter said, the rules were contradictory and unclear, I think they said, or at least unclear. And that's definitely the case. That was part of why UNICAP came out in 86. The rules just didn't make sense as they were. So not a lot of good news on the cost seg front, but there should be some opportunities.
Well, that's just in terms of the small taxpayer regs.
Right. Just from small taxpayers.
I mean, we've covered a lot of ground in this conversation.
Yes.
I think it's kind of worth kind of going back and hitting some of those points because the big takeaway at this point, here we are. Is it too soon to say Happy New Year? We're practically there. I can't wait till 2021. But as far as property owners, those who rely on depreciation significantly in their businesses, it's been a pretty phenomenal year. You'd be hard pressed to find other years that had as many significant pieces of legislation, regulation, and procedural guidance, that occurred. And we started off the conversation talking about the CARES Act and the fixing of the retail glitch, which was fixing QIP property, which was broken under the TCJA. We forgot to talk about. Forgot to mention that also in the CARES Act was the ability to carry back. Which is pretty important for a lot of taxpayers who are trying to free up capitals. The ability to look backwards. Brian, is it 4 years, right?
5 years.
5 years. Sorry, my bad. I should have that memorized. But that was really important.
Walk us through that because if you, especially for this year, if you're in a loss, give us an example.
Right. So. For a lot of taxpayers who are not having the best year this year, but had great years in 2020, we are in 2020 still, in 2019, 2018, 2017, et cetera, they can free up capital by performing a cost seg study, for instance, and applying it backwards up to 5 years. And
go ahead, and then I'll ask my question.
No, please ask your question.
Let's say they can carry it back to 2015, which tax returns closed. How does that work?
There's actually a part of the statute that says ordinarily you get 3 years to file a refund
Right.
claim. But let's say you have an NOL generated now that gets carried back 5 years.
Mhm.
That opens up the statute for that older year to carry back, and it has a specific, carryback provision of its own. I believe it's the same the carryback is open the same amount of time as the current year that generates the NOL is open. So you basically get a slight extension of time for that, but it's not indefinite, and it doesn't allow you to do absolutely everything on the older return that you'd want to.
Right.
Right. So you carry it back, you get a refund check by doing
A
that?
refund check plus interest.
Plus interest.
Not too bad, right? And so, I wanted to bring that up with the CARES Act. I wanted to kind of circle back around to that. And we talked about the new omnibus spending bill, and specifically the making of 179D permanent and the 1-year extension on 45L. There's a whole slew of regulations that the Treasury got out this year, for bonus depreciation, the 1031 like-kind exchanges, which was great to get clarification on that, 163J, and then the small taxpayer regs that Brian just mentioned, was talking about just a short while ago.
Yeah.
And then the other thing, which we didn't get into any detail on, but along with all these regs and new legislation, was the procedural guidance, Rev Procs 2020-22, 25, and 50. Excuse me, I'm reading from notes because I don't have it all memorized at this point.
Yeah, there were more Rev Procs than that, and they're going to continue to be more Rev Procs than that. But it's gotten to the point where these revenue procedures are so self-referential that it would take more than an hour presentation to walk through all of them in detail.
Yeah.
Okay. Well, we do have the time. I'm sure you guys don't want to go through all that in great detail. Can we just go through some of the highlights then? Is that possible?
Yeah. A lot of the concern for these Rev Procs is, one, how do you implement the fix to retail glitch? But at a high level, these are the most favorable tax accounting procedural guidance projects we've seen. Normally, if a taxpayer has used an impermissible method of accounting, which for depreciation, a lot of the stuff that's wrong is going to be an impermissible method, we have to, after filing it for 2 years, you have to use a 3115. Well, they're treating the 39-year QIP, pre-retail glitch fix, as an impermissible method, they being the service. So ordinarily, you'd be limited to filing a 3115, but now you can file amended returns or an administrative adjustment request if you're a BBA partnership. And if you are, you probably know that you are, because that's a very technical issue from 2015. But when you're looking at, not only did they allow us to file amended returns generally, which is pretty much unheard of for an accounting method change, they also still retain the option for 3115s in most cases. They also have wonderful chances to make late elections, to withdraw previous elections, or to revoke previous elections for such things as electing out of bonus depreciation entirely for a class of assets, certain elections related to grafted plants qualifying for bonus, and also in some cases you can amend a return to withdraw the election for electing into ADS, and that's a huge issue, kind of technical, but a lot of people, when they intended to make the real property trade or business election to get the unlimited interest deductions, they didn't actually do it right. All they did was elect ADS for some property. Or they did the election right, but they included too many classes of property in their ADS election. So some of the stuff was required to be ADS because they made that interest election, but then other stuff they also put on ADS and elected into it. So
Yeah,
there are all
a
kinds
lot
of
of people
fact
made that
patterns that
mistake.
come up.
Yeah. Well, so let's circle back around to specifically the retail glitch. If a taxpayer had already filed, they filed their 2019 tax return correctly at the time. In other words, for 2019, QIP property was 39-year property with no bonus depreciation, but it could qualify for Section 179 expensing. So if someone had correctly identified QIP as 39-year property and did not apply bonus, that was a permissible method in 2019, based on the literal bill, TCJ, how it was read into law. Suddenly, you get into the CARES Act, and what had formerly been a permissible method is now an impermissible method, which is a favorable change. But because they're treating it as an impermissible method, that gives you the flexibility of filing the 3115 or the amended return in this case. Is that correct?
Right. Generally speaking, that's true. One thing I should mention, a lot of taxpayers, especially smaller ones, they looked at QIP, they knew it was 39-year, but they also knew it was eligible for 179 expensing.
Mm-hmm.
So they made the call and said, okay, I'm just going to expense under 179. And so a lot of them are looking at that election and they're wondering,
smaller ones primarily.
Yeah, smaller ones because of the 179 expensing limits. But a lot of these guys, these taxpayers, are looking at that election and saying, should I switch to bonus? And pre-CARES Act, the answer was, well, no, you stay with 179 because the TCJA had limited what you could do with NOLs. They didn't have carrybacks anymore, and they were generally limited in any year to 80% of taxable income. Well, that's a horrible answer compared to what they were historically, where you could carry them back for 2, 5, maybe sometimes 10 years, depending on what you're talking about, and you could, offset everything. But 179 has its own offset provisions. If you have too much 179, too many 179 deductions compared to your active income from a trade or business, then the excess gets carried forward. Mm-hmm. And it gets carried forward at 100%. So assuming the trade or business has active income and that's all it has, then when you make the expensing election pre-CARES Act, you actually had a better deal. You could offset 100% going forward instead of taking a 20% haircut for an NOL. Mm-hmm. But now, with the CARES Act changes, NOLs go back 5 years. You don't have, at least temporarily, you don't have the 20% haircut, and you're going to probably want to change. If you had better years pre-CARES Act than you do now, you're probably going to want to change the 179 expensing election to a QIP treatment, get the bonus, and make it an NOL. Mm-hmm. And the best way to do that, 179 is an election. You can't fix it using the automatic method changes. You have to go back and amend the return to fix it. And while you're amending the return, you might as well treat it as QIP 15-year with bonus. Mm-hmm. And then generate the NOL and carry it back, which is great news for a lot of taxpayers. And there are incidental benefits. QIP with bonus has better recapture rules than 179. Mm-hmm. If you're dealing with a situation where a building with QIP is going to be sold in the near future, and you have the option of changing from 179 to bonus treatment, it's usually a good call to do that because 179 gets recaptured entirely, while bonus only gets recaptured where it's in excess of straight line depreciation for QIP. So a lot of options, a lot of little planning ideas that you can think about around that.
So And thank you for sharing all this. I mean, this is a unbelievable amount of information.
It's been an amazing year. And most of these topics can be a half hour to 1 hour conversation by themselves.
Oh, no doubt. I mean, clearly. Is it too late? I assume it's not, but I'll ask it anyway. It's not too late to make some of these decisions. I mean, we're 2 days left in the year, actually a day and a half left in the year. Do people have to jump on anything right now, or is it something that we can like visit in the first quarter of next year?
Honestly, most of it, most of this is teeing people up to have the knowledge going forward into the next year.
Okay.
That now that we're about to enter into tax season once again, it seems like tax season never ended last year, but
We heard that from every CPA, and it hasn't.
pretty much. Actually, I think the last 2 days have been the only quiet days I've had the entire year. That's because everyone's on vacation. Almost pretty much everything we've talked about, it's good to know. It was good to know in 2020, but it's good to know going into the 2020 tax year. Which basically just now beginning, having that knowledge now so that you can decide whether or not you need to make a particular election, whether you need to hire someone to perform a particular service, whether it's 45L, 179D, cost segregation, getting your CPAs ready for all the 3115s they may or may not need. This is useful information going into January, February, March, and beyond.
Yeah, absolutely. And I know that what I like about these live broadcasts is that they're recorded, so they'll stay on. And so it'll be useful for people to make reference back to this conversation and revisit it. And there'll be, I will try and do some editing and cut out certain sections so people can make reference to those in particular. Anything else that you guys want to share that you want to highlight before we wrap up?
Brian, what have we forgotten? As I mentioned, in these topics we can go into for another 30 minutes to an hour. So
I would say that the big deal for right now, most taxpayers are going to be looking at PPP round 2 and ERC credits. They're not going to get back to tax accounting until afterwards, most likely. So we anticipate that most people will be looking at this in the February to March timeframe, no earlier. A lot of taxpayers will go on extension. We don't know if, we can't know at this time whether tax season is going to get extended like it did last year, which it very well might. I mean, there have been talks about it, which the IRS, quickly quashed, but people from the IRS were talking about, having contingencies in place to extend the tax season just like last year. So
it wouldn't be surprising.
Yeah, we'll see. I anticipate that the service will remain as friendly and flexible, at least on the guidance side, as it has been in the past.
Yeah.
But I think the really good news, and this has always been the case, but particularly this year, is that if you need to free up capital, these tools that we're talking about, whether it's cost segregation, 45L, 179D, the carry back of 5 years, these are great ways of freeing up capital in a year where that capital might be scarce, and it's significant amounts of capital.
Absolutely, and we've experienced it in working with some of our clients within the past couple of months.
Oh gosh, yes.
They've recognized it. So, yeah, out there on YouTube, LinkedIn, and on Twitter, if you have questions, you need more information, you're not quite sure which route to go, or any technical questions that you have, my information is scrolling on the bottom. You can always ping me on LinkedIn or on Twitter. YouTube, I don't know if there's a connection way to do that. But it was thank you guys again for coming and doing this, because it's a lot of information, and I could see how people that don't have the right advisors in place can be completely overwhelmed and potentially do things the wrong way. And that's a no-win situation for everybody. So we appreciate it and want to make sure people know that you guys, that we're here.
No, we're happy to do it.
Yeah.
Thank you for having me.
to you and to everybody out there, Happy New Year. Happy, healthy, safe New Year. Looking forward to 2021. And guys, enjoy. Thank you.
Take care.
Take care, everyone.
Bye.